Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are going to be solving the FM March-June 2023 question number 1, which is Graffham company. So this is the first question in the section C that is given on the practice platform, and it is here that I'm solving this question. So as I can see that the requirements are, the scenario is present over here on the left hand side, and I do have the requirements also with me. So going over the requirements quickly. So first part is TERP calculation. Then I have to find out the EPS before the investment. Then I have to calculate the revised EPS after the investment, assuming that the rights issue is successful. Then I have to calculate the gearing and revised gearing. Okay. And then I have to discuss the view of the directors, both the large and small shareholders, in relation to the project and its financing. So I can know that 4 parts over here are absolutely based on calculations. Calculations are what? 2 plus 2, 4, 4 plus 3, 7, and 7 plus 2, 9 marks. So let's get started. I can write over here that this is my answer to part A and 1. So the first thing that I want to calculate is the TERP, and this is per share. TERP, I can also say per share. So let's read the scenario. Graffham company's directors are planning to invest in a new project which requires 18.9 million of new finance to be raised. Graffham company's directors have used a mix of debt and equity finance to finance the recent investments, but have become concerned about the level of Graffham company's gearing compared with the industry average. Therefore, they have decided not to use debt finance to fund the new project. Okay. So the finance director has proposed a 2-for-5 rights issue to existing shareholders at a 25% discount to the current share price of $8.4. The nominal value of the ordinary shares is $2 per share. However, Graffham Company's chairman has received objections from some small shareholders owning less than 5% of the issued share capital each, on the grounds that they do not have sufficient cash available to pay for the new shares, and large shareholders shareholders owning more than 10% of issued share capital each and 50% in total will be happy to subscribe for a rights issue. However, they want the new project to earn at least the same operating profit margin in percentage terms as Graffham Company's current business does. So operating profit margin, the formula is given to us. Then we have some information about the financial statements, and then we have the corporation tax rate, the nominal value of Graffham Company's loan notes at rupees 100 per loan note, and market value is 110. PE ratio is assumed to be unchanged. All right. We have the gearing formula also given to us over here, and the current average industry gearing ratio is 25%. The new project is expected to earn 20 million revenue each year and have an operating profit margin of 18%. If the project is successful, there are expected to be opportunities in future to invest in further projects offering higher operating profit margins. So first of all, let's work out the TERP, as the first part requires us to do that. So it is mentioned over here that the existing shareholders will be given a 25% discount to the current share price of 8.4. So first of all, how much is my rights issue price? So my rights issue price is nothing but 8.4 multiplied by 1 minus 0.25, or I can say 25%. So with this, I have the rights issue price, that this is the price at which the shareholders are going to be offered to buy these rights shares. Then how do we find out the TERP? TERP per share will be nothing but, first of all, for the numerator, we are going to take how many number of shares do you need? Originally, you need 5, and the market value of those 5 is 8.4 per share. And then you add how many you are going to purchase on the rights issue. So 2 multiplied by 6.3 is the rights issue price. Now this becomes my numerator, and this has to be divided by the total of these, which is 2 plus 5. So 2 plus 5, and with this I obtain my TERP per share. So this is my answer. I can also highlight this. Right? Now let's move on to the second part. Calculate the current EPS before the investment in the project. So I can say that this is part 2, and this is the current EPS. So we have some information given. This is the profit before interest and tax. Then we have ordinary shares, retained earnings. All right. So how do we work out the EPS? For EPS, we want how much is the total earnings, and then we'll divide that by the number of shares to find out the EPS. So first of all, we only have given with us the PBIT, profit before interest and tax, given to be 9,500. So PBIT is given as okay, I can perform this over here. 9,500 is the PBIT which is given to me. Then before interest and tax. So I have to subtract the interest as well as tax from over here. First of all, let me subtract my interest. So my interest will come out to be 25 million is the debt that I currently have. So yes, so 25 million is the debt that I currently have, and 8% on this is the interest that I'm going to be paying. So 25 multiplied by 8%. So with this, I have my finance costs. So 20, all this is in millions so far. So let me put three zeros. So 2000 comes out to be the finance cost that I have to incur. So with this, I will have my PBIT also. I can say, okay, we can write less interest so that this problem is solved. Okay. Now, the next thing, now we have the profit before tax, then we need to subtract the tax. Tax, if I remember, yes, it is at 16%. So 16% equals to, okay, so PBT will be this minus this, and then tax will be equals to minus this into 16%. So this is the tax that I'm going to be paying on my profits. And then the net figure is what will give me the profit after tax. Now I have my profit after tax. Now the next step over here is to find out my number of shares. I have my numerator for EPS. Numerator is profit after tax, and then the denominator is the number of shares. So to find out the number of shares, what I'm going to do is I do have my ordinary shares given to me as 15,000. This is an 15,000. So this becomes 15 million. And this is the number of shares that is given to me. Let's find out how much is the nominal value of the shares that we have over here. So let's scroll down. Yes, so the nominal value of the ordinary shares is $2 per share. So I can find out my number of shares now. So my number of shares becomes, how much is the nominal value given to me? That was 15,000, right? So 15,000, and divide this by 2 to find out my number of shares. Now my EPS is very simple. I just have to divide this by my profit after tax to find out my current EPS. So my current EPS equals 6,300 divided by 7,500, and this will give me an EPS of $0.84. I can also format this as currency so that it looks better. Currency with two decimals, yes. So current EPS, and I can also highlight this, that this is my final answer. Now the third part that we have to do over here is we have to find the revised EPS and the share price after investment in the project, assuming that the rights issue is successful. So I can put over here that this is the solution to my third part. I have to find out the revised EPS and share price. So let's have a look what will happen if we are putting our money in this project. It is mentioned over here that we require 18.9 million of finance to be raised, and how much is our profit going to be? Let's find that out. So profit before interest and tax divided by revenue into 100% gives you your operating margin, and it was given that for this project, the new project is expected to earn 20 million in revenue and have an operating profit margin of 18%. So how much is going to be my profit? So my profit on the new project is going to be 18% of 20 million. So 3.6 million is going to be my profit over here. Then I will add this to my existing profit that I was previously earning. So previously my profit used to be 9,500. So either I can convert this into millions, this into the absolute figures, or take this as millions. So I'm doing the other way. I am taking the profit before interest and tax as given to us. I can say that this is my existing PBIT. So if I add, so this will be my revised PBIT. So revised profit before interest and tax will be the sum of these both figures. And then I need to find out my finance costs and then deduct my taxation. So since we are not issuing any debt, my finance cost remains same. So less interest. I'm just copy pasting this over here. Right. So now I have my interest. Now I come to my PBT, which is my profit before tax. So it is this figure minus this figure. Now this is my profit before tax. Now I will subtract the tax. Tax is at 16%. So I can say my tax will be this multiplied by 16%. And if I forgot the percentage sign. Right. So if I subtract 16% from this, I will have my profit after tax. And now let's have a look at the number of shares. Earlier, the number of shares that we had found out was 7,500. Now we are going to add to this the new shares that we are issued. So revised number of shares will be first of all adding this number of shares which was existing, that was 7,500. So 7,500 plus how many have we issued now? So now we are going for an issue of 2 for 5, right? Yes, 2 for 5. So my total number of shares is 7,500. So I will go for 2 new shares for every 5. So this will be this multiplied by 2 by 5. So with this, I will have my new number of shares, and my new number of shares comes out to be 10,500. And then I can find out easily my revised EPS. So my revised EPS will become profit after tax divided by the revised number of shares, which is 0.888. I can format this as currency, and with this I have my revised EPS also. Now I will have a look at another thing that we want to find out over here is the share price. So for share price, what I'm going to do is, first of all, we were told over here that we have now our EPS, and then we were told that our PE ratio is going to remain the same. So the price earnings ratio can be assumed to be unchanged undertaking this project. So let's find out how much is our PE ratio before the rights issue. PE ratio before the rights issue. So PE ratio is nothing but the price divided by the earnings. So the price per share was given to us as 8.4. Yes, here is the price 8.4, and I will divide this by my earnings. So my earnings I had just found out over here, it was 0.84. So 10 is my PE ratio before the rights issue, and it is said that this ratio will remain same. So my revised share price will come out to be PE ratio multiplied by my earnings per share. So with this equals to 10 multiplied by your EPS. So with this we arrive at 8.88. This will be our revised share price. I can also format this as currency. Right. So I can highlight both of these as my answers because this is what the ultimate requirement was. Now let's have a look at part 4. Part 4 wants us to find out the current gearing and the revised gearing. using market values and assuming that the rights issue is successful. So over here, I will put my heading as point 4, and I have to find out current gearing and the revised gearing. So current gearing and revised gearing. So starting with that, we have the formula given to us as to how the gearing is calculated. It is non-current liabilities divided by non-current liabilities plus equity multiplied by 100 to convert it into a percentage. So for my current gearing, first of all, let me get the values that are required in the formula. So before the rights issue, we do have non-current liabilities of 25, 25 million, and then we also have equity. Equity is, we have to base it on market values, right? So for this also, for your non-current liabilities, we have loan notes. And so let's first of all calculate the market value of loan notes. So for my loan notes, I have 25,000 given to me, and the nominal value that I have is 25,000, and the nominal value that is given is 100. And then it is also said that the market price per loan note is 110. So that means this is my market value of the loan notes as of now. And how much is my market value of equity? My market value of equity is 8.4 multiplied by the number of shares. So 8.4 multiplied by number of shares we had just found out, 7,500. So with this, I have both my market value of equity as well as my market value of loan notes. Now let's put this into the formula of gearing that is provided to us. So current gearing will be, first of all, my numerator is non-current liabilities. So this is this divided by non-current liabilities plus the equity. So this is equity. And for the equity, what we are going to write. So with this, we achieve operational gearing ratio given to us as 30.39. Now I go to my revised gearing. So for the revised gearing, we have to find out the market value of equity and then the market value of loan notes again. So considering that the loan notes remain unchanged because there is no change with respect to the debt that we are taking. So I'm just pasting this over here. And then with regards to market value of equity, we found out the share price, right? So the revised share price will be 8.88 and the revised number of shares will be 10,500. So I can just link my calculations over here. 10,500 multiplied by the revised share price, which we found out as 8.88. So this will be the revised market value of my equity. So my revised gearing will come out to be, again using the same formula, non-current liabilities divided by non-current liabilities plus the equity, and then converting it to the percentage format. So with this, I can see that on a rights issue, my gearing will reduce and it will come even below than what is the current industry average gearing figure. So with this, we have finished part 4 also. Now we're done with the calculative aspects. We can also highlight the final answers. So this is our final answer, and this is also the final answer. Now let's read part 5. Part 5 says, discuss the views of the directors and both the small and large shareholders in relation to the new project and its financing. So you, considering this is for 5 marks, you can form 3 short paragraphs where you can explain the stance of each of these groups of people that have been mentioned. So first of all, let's talk about directors. So with respect to directors, we can say that the current level of gearing, current level that we found out, 30.39, exceeds 25%, right? So what happens over here is the directors are concerned considering the fact that the gearing of their company is higher than the industry average. So the new gearing ratio, if they go for the rights issue to finance this project, the new gearing ratio will definitely bring you to the, very close to the industry gearing ratio. In fact, you will be lower than the industry average gearing ratio, and that is why the directors want to go ahead with it. Now let's talk about the small shareholders. What are their concerns? Small shareholders. So these are those people who are, it was given to us that they hold lesser than 5% of the capital, right? Less than 5% of the issued capital, yes. So we can say that the small shareholders do not necessarily have to subscribe to the rights issue. They can sell their rights if they do not have the cash, right? So selling their rights will although lower their shareholdings, but their shareholdings are already small, so it is unlikely to make any major difference to the influence that they have. So currently also they are not having a very big influence on the company, considering they are owning less than 5%. So even if they are not able to take the rights, this 5% may still go a little bit down, but then even now also they are having no influence on the company, little or no influence, and even when they do not take up the rights, they will have little or no influence over the company. Now let's talk about the large shareholders. It's said over here that the large shareholders are owning more than 10% of the issued share capital each, and they account for 50% of the total share capital that is issued by the company. So that means that let's first of all find out. So for the small shareholders also, we could show a calculation that how much they can gain. So the new share price that is given to us, that we found out rather. So the new share price that we found out was 8.88, and then the earlier share price before this rights issue was 8.4, right? So this is the amount of capital gain that these people, the small shareholders, can be making. Um, did we take the right figure? 8.88 minus your 7.8 rather, which is the price at which they can buy the shares, right? The TERP. So this is the amount of capital gain that the small shareholders can be making. And then talking about the large shareholders, they want a return of, it is said over here that they want the same return as, however, they wanted the new project to earn at least same profit margin in terms of current business things. So it is mentioned that currently we are earning currently how much is our operating profit margin? Let's find that out as well. So currently our operating profit margin is nothing but, first of all, I take my PBIT, which was 9,500, and then I divide that by the capital that has been employed. So I divide that by revenue for 45,200 to find out my current operating margin, right? So my operating margin as of now is 21.02, and talking about this project is giving only an operating profit margin of 18%. So that means this criteria is not being met, that is set by the large shareholders. And even though the project will result in positive long-term increase in the shareholder wealth, assuming that it has a positive NPV, and it will also be a gateway for investing into further projects. It's mentioned over here, right? That there are expected to be opportunities to invest in further projects offering higher operating profit margins. So that means that the shareholders can be convinced that, okay, even though this project does not meet your criteria, but in the long term, you will be benefiting. There is a positive NPV, and you will also get the opportunities of investing into more projects with higher operating profit margins. Now let's talk about the last requirement. This is a 6-marker requirement. One of Graffham company's non-executive directors has suggested using Islamic finance, either a mudaraba contract or a musharaka contract, as an alternative to the rights issue. Discuss the use of a mudaraba or musharaka contract as possible alternative sources of finance for the new project. So first of all, there will be 3 headers over here that you will make. So that will be, first let's write over here. So first let's talk about mudaraba, then about musharaka, and then you will talk about what is the one that they should be going for. You can say that this is more like a recommendation or something that will be appropriate for them. So you can say comments, right? Let's talk about each of them one by one. So first of all, we talk about Mudaraba. So for Mudaraba, first of all, you will explain what it means and what it will mean for the company, the Graffham company, right? So Mudaraba basically is a profit sharing agreement, and it is between investors and the company. So the investor will become the sole provider of the capital. The management of the venture would be the sole responsibility of the company, which is Graffham company. And since Graffham company has an expertise in running the profitable business. Now, under this contract, the profits will be shared in a pre-arranged ratio. Only the capital provider would bear any losses, but would only be liable to the extent of the capital that they are providing. So this is it that you will talk about the Mudaraba contract. Then let's talk about Musharaka. So for Musharaka, you will say that along with other investors, Graffham company will contribute the capital, and this will be more like a joint venture, right? So net profits will be divided in the pre-arranged ratios. Any losses would be borne by the partners in proportion to their net capital contributions. All parties will be involved in the management of the venture, though they might choose not to be. So another difference that we spot over here is that Mudaraba does not involve participation from the capital provider, but here in Musharaka, everyone will be providing the capital and they will be participating in the business also. Now let's talk about the comments, as in what is more suitable for Graffham company. So from the company's point of view, Musharaka would still mean that Graffham company would have to contribute some capital, raising the issue of how this contribution would be financed. So now capital is the main problem, right? That is why they want to go for a rights issue. So a Musharaka contract is not very suitable over here. But a Mudaraba contract will be more advantageous. How? Because the capital provider will be contributing all the capital and will also be bearing all the losses. So that means, and they also get the advantage of, no interference in management also. So even though both contracts will give them stability, both will also give a longer term investment and relationship based on mutual interest and cooperation. Business operations under both types of contracts would have to be run in compliance with the Sharia law, considering that they are both contracts under Islamic finance, and Islamic finance is governed by the Sharia law, right? Then you will also talk about how these arrangements are an effective provision of equity finance by external providers, which will not result in the external providers getting the shareholdings in the company. However, we will also say that the large shareholders might not welcome the new project if the profit sharing ratio with Graffham company negotiated combining with the operating profit margin did not appear to be adequate for managerial resources committed. If a Musharaka contract is used, the overall profit obtained must be sufficient to compensate for the financial resource invested as well. So even if you write 2 marks worth of explanation in all 3 headers that I have mentioned over here, it will be a good way for you to earn the available marks. So with this, we have come to an end to Graffham company, and in the following videos, we will be solving more past paper questions. Thank you so much for watching. I hope that this was useful. Stay tuned for the next one.